Welcome back. Still with me in the studio, Andrew Kinsey, Head of Risk at GT 24/7. We're talking about offshore investing. Right, I'm a little bit calmer now. Let's take this slowly now. I must either make the decision that I'm going to take 100,000 Rand and put it into US dollars, and that money is then that is a dollar investment.
Yep.
And so don't look at the Rand dollar exchange rate all the time, because that is invested for a specific reason in dollar-based companies.
Exactly. And the key is that you've taken that money offshore with the idea that you're going to diversify. There are plenty of investment opportunities available here in South Africa. You've got bonds, you've got equities. There's a whole universe of investable opportunities here. But you've taken the decision to move the money offshore because you want some type of diversified asset base. Don't get scared if the Rand moves against you. That can't be now part of your investment or trading idea. What you now have is a dollar-denominated money market asset if you've put it into a bank, and now the decision is to what type of asset or asset class do I put that money to work in.
But why should I take all of this risk, Andrew, when I could be investing offshore through a South African fund?
Well, the reason is that a lot of people like to do it is that they believe that the costs would be lower. Because if you're doing it through a fund, they're charging you 1%, 2%, 3%, 4% management fees to start with. People like to, and this is what we advocate, is that in some way or sense, everybody needs to start taking responsibility for their own financial future. Don't wake up at 65 or at 50 or whatever the story is and say, I've got no assets on which to live in. And many people do that. They wake up, they haven't provided enough for their retirement, they haven't planned. And taking that money offshore must be part of the plan. It can't be some sort of act that you just act on, I have a couple of beers with the guys on Saturday afternoon, Wednesday you take 100,000 off because there's a bit of a punt.
It's probably the worst place to take that sort of decision.
Exactly.
Yeah. Okay, so now I've taken my 100,000 Rand offshore, and it's now sitting at, it's now worth $4.50. Right. The 100,000 Rand. Yeah. Okay, and I want to invest it. Yeah. How do I then start working out? How do I build my portfolio? Yeah. And where do you guys come in there?
Well, what we do is we have a partner platform that provides dollar or euro or sterling denominated assets, or we provide locally Rand-based assets to that. So there's two avenues to get to it.
But I'm going
you're going the offshore.
I'm the offshore one.
Basically, you need to start doing the work in terms of what do I believe is the most appropriate investable asset for me. What do I understand? What's my skill set? Have I done enough work? Because people take the money offshore and then they think to themselves, now what am I going to do with this stuff? It should have germinated a long time before you took the money off, and you say to yourself, I understand equities. I understand the German banking system, or I understand British retailers, for instance. Go into a market that you believe that you have researched thoroughly, either by your own experience or by reading publications. So the same rules that would apply here in South Africa, where you trade and invest, it's based on you actually doing the work. Do I understand bonds? Do I understand equities? Do I understand the way in which commodities react? Because that's the universe of assets that are out there.
But for the man on the streets, I mean, I understand a little bit about equities.
Yeah.
I don't understand bonds.
Yeah.
It's been explained to me I don't know how many times. I'm just bond stupid. Okay, the point I'm trying to make here is I understand equities to a certain extent, so I would only find myself trading in the equities field, which to me I think is very dangerous because you're only exposing yourself to one aspect of a whole range.
I think that the investing world is not that complicated. It's guys like me who make it complicated because that's how we protect our jobs, right? We make it sort of basically opaque to everybody else. But it's not that difficult. If you do, just, you know, if you were studying for any type of exam, you were studying for a history exam or a geography exam, it's getting through that jargon and suddenly it becomes familiar and you recognize trends, you recognize ideas. And really, I can't stress too much. There are two keys to being at least moderately successful, if you're not going to be incredibly lucky. Work hard, because it's just like anything. The number of times we see people who have worked hard for 15 or 20 years, have built up capital in a baker, butcher, you know, environment, and then come in, you know, as if they were in a casino. And you know that the casino is the house and it will take your money. But provided you do some work, and provided that you're in it for a reasonably long term, if you're in there trading every 2 minutes or so, chances are you're going to just be giving money to the financial intermediaries. But the world of finance is not that difficult. Contrary to your belief, bonds are actually much more simple than equities. Currencies are the flavor of the trading world at the moment because they're very, very liquid. You can get in and out of them. There are some broad themes. And I think that if you are contemplating investing and trading offshore, build yourself an architecture of understanding. So let's just say that there are 4 basic asset classes: equities, bonds, commodities, and currencies. Out there are many more, but it becomes more and more esoteric and difficult to understand.
Okay. So we've got again, what equities?
Equities, fixed income or bonds. Currencies, and commodities.
Okay, right.
So that would be your 4 very broad asset classes. And build up an understanding of how that asset class interrelates with one another. So if equities are going up, what's likely happening to bonds? If the currencies...
What is likely happening to bonds?
Well, typically you find that portfolio managers, very large portfolio managers who run these balanced portfolios, will tend to be overweight equities. Equities have performed reasonably well, you know, over a sort of 40-year period, certainly not over the last 10 years. In nominal terms, even though we're trading at near highs, we haven't progressed any since 2000, really. Fixed income or bonds have produced magnificent returns. Can you imagine in the United States that overnight interest rates 30 years ago were 12.5% and 13%, not 10 basis points or 0 as they are now. So fixed income instruments have produced massive returns for investors, certainly over the last decade and a half. Commodities have been in a secular bull market essentially since the turn of the century.
What is the secular bull market?
If you imagine that you have a cycle, and a cycle can last anything between, say, 6 months or 2 years. So those would be relatively short-run periods, where commodities run in these sort of waves, these long waves. We refer to it as a secular bull market. So commodities have been in a bull market for, say, 10 or 15 years now.
Okay.
And we may be reaching the top, there may be another few years. But if you go back to the early 1990s, or even, say, 1997, 1998, where could you have bought gold? You could have bought gold at $250, $300 an ounce. It's now at $1,800, and people are desperately wanting to buy it, whereas everybody was ignoring it. You know, it's at $250, $300. And that's probably another thing, is that people should be prepared to be contrarian. So there are a lot of assets that are overpriced and overvalued now because people are pricing in an apocalypse, say, in Europe. So people are buying German bonds and US bonds. And they're expensive now on a relative or even on an absolute basis. So perhaps that's not where you should be putting your money.
So I want to just try and get a view here. So you're saying that equities have not performed as strongly?
Certainly over the last decade, in real terms, they haven't.
And that's led to a rise in the bond market.
Yeah.
The commodity market is its own beast, which goes along.
Yeah, and that's a good thing, because it often works counter-cyclically to equities.
Okay.
So that you have these long periods of commodity waves that provide you with some diversification.
So you've got, this is coming down, that's going up.
Yeah.
We've got a nice wave here, and then we've got currencies, which is a ping-pong ball going up and down.
And now it's a real war, because what are all the monetary authorities, and this is part of the thematic that I think people should understand, is that all the central banks, all the major central banks around the world, if you look at the Swiss, you look at the Europeans, you look at the British, the Americans, and the Japanese, what are they trying to do? They're trying to devalue their currency in order to make their exports more competitive. So it's a race to the bottom, essentially. Lowest common denominator. And people like, or countries like ourselves, and the Australians and the Kiwis, commodity-based economies, our currencies arguably are probably too strong, because we're getting caught up in this currency war, unspoken for the moment, but it can get ugly, where people are saying, how do we possibly grow our economies other than by devaluing our currency? So they're trying, the Americans are trying to weaken the dollar, the Japanese are trying to weaken the yen, the Europeans are trying to weaken the euro. You know, they're all the same coin, so one must lose. And I would put my money on the Americans winning. They've just got much more firepower than anybody else.